Good day, everyone. I am Crystal Joy E. Demandante, and I am the first reporter of Group 5 with the topic of depreciation and capital budgeting. So, to begin, what is depreciation methods? Depreciation is the systematic allocation of the cost of a tangible asset over its useful life. It reflects the decrease in the asset's value due to wear and tear, obsolescence, or other factor. There's two common methods in depression. First is straight line depression. Straight line depression. The formula is open parenthesis cost minus salvage value close parenthesis over useful life. So this method evenly distribute the assets depreciable cost open parenthesis cost minus salvage value close parenthesis over its useful life. So the example of this is a machine costs $10,000, has a salvage value of $1,000 and a useful life of 5 years. The annual straight line depreciation is $10,000 minus $1,000 divided by 5 is equals to 1,800. So you can try it to calculate in your scientific calculator to double check if the answer is correct. That's all for my part, and the other topic will continue by my co-members.
Good day, everyone. Hi, I am Georgian Almandeg, and I am going to discuss to you the declining balance depreciation. So, the formula in declining balance depreciation is 2 all over useful life times book value at the beginning of year. This is an accelerated depreciation method, meaning it allocates a larger portion of the asset cost to the earlier years of its life. Depreciation expense decreases each year. The book value is assets' original cost less accumulated depreciation. A common variation is the double declining balance method using 2 all over useful life, but other multiplies can be used. Example, using a machine that costs 10,000, salvage value 1,000, useful life 5 years. The depreciation for the first year would be 2 all over 5 times 10,000 is equal to 4,000. The book value at the beginning of year 2 would be 6,000 times 10,000 minus 4,000, and the depreciation of year 2 would be 2 all over 5 times 6,000 is equal to 2,400. This continues until the book value reaches the salvage value. Note that you never depreciate below the salvage value. That's all for my part. Thank you for listening.
Good day, everyone. Today we will discuss about capital budgeting. First is the in capital budgeting there are two methods used to make decisions. First is the MPB and the IRR, but I will only discuss NPB. NPB calculate the difference between the present value of cash outflows over a project or project's life. O ito yung ito yung using NPB, you can calculate the difference between the present value of cash outflows and the present value of cash inflows. A positive NPV indicates that the project is expected to generate more value that it costs. So if the pag ang result ng NPV is positive, then it is expected to generate more value of than it costs. Sa madaling salita, kung positive ang NPV is expected na marami ang income kaysa sa cost nito, and making it a worthwhile investment. But if a negative NPV suggests the opposite. um, if the if ang result ng NPV is negative, well, it is expected that yung mas malaki ang cost kaysa sa value nito in the present time. And next is the formula. Formula of NPV is cash flow in period time over 1 plus rate discount raised to the power of time period. And I have here an example here. Imagine you are considering investing in a new machine for Quezon City business costing 100,000 pesos. You part- anticipate this machine will generate the following cash flow over the next 3 years. The first year is 40,000, next is 50,000, then third year is 60,000. And let's assume that your company required rate of return, which is 10% per year. So first is calculate the first year. Let's use the formula, which is cash flow in period or time period, then over 1 plus R, which is the rate discount, and over raised to the power of time rate. Here, in first year, 40 40,000 over 1 plus 0.01 raised to the power of 1, 0.01 because 10%, the decimal of 10% is 0.01. So, and equals, the first year is equivalent to 30,000, 36,363.64. The next one is second year. Let's also use the formula. 50,000 over 1 plus 0.01 over 2. Remember that the formula is raised to the power of t, which is t, the time period, and we are in the second year, and equals to 40,816.33. And as follow, year 3, 60,000 over 1 plus 0.01 raised to the power of 3, it equals to 46,601.75. So that, then for you to be able to get the NPV first, you will add the result in first year, second year, and third year, so that, and then you will subtract it to the cost of that machine. Kung magkano ang machine na yun na bibilin mo. So here is 360, no. So next is um, 36,363.64 plus 40,816.33 plus 46,601.71, it equals to 123,781.60 68. Then, yun na nga, you will subtract that to the original cost of that machine, which is 100,000. So, 123,781.68 minus 100,000. It equals 23,781.68. So, that is your NPV. So, positive siya. So, meaning it is expected na mataas ang ma-generate or mataas ang expected na value ng money than it costs. NPV of 23,781.68 is positive, indicating that the investment is expected to generate a return exceeding the required rate, which is the 10% rate. Therefore, based on this NPV calculation, investing in the machine is a financially sound decision. That's all for my part. Once again, this is Marian Family Nakalunsag, um, Group 3. Group 5. Okay na.
Now we discuss about the internal rate of return or IRR. IRR is a discount rate that makes the NPV or net previous value of a project equals zero. It represents the project's expected rate of return. Next is calculation. IRR is typically calculated using financial calculator or software. There is no simple formula for direct calculation, and the decision rules for IRR is accepted project where the IRR is greater than the required rate of return. Next is comparing the NPV and IRR. The NPV or net previous value directly measures the increase in the value, easier to interpret for manually exclusive project. I choose the project with the highest NPV. IRR provide a percentage return, can be more initiative to understand, but can be lead to ambiguous result in certain situation. Example, we use multiple IRR conflicting ranking for manually exclusive project. Example of NPV and IRR. Let's say a project requires an initial investment of 100,000 US dollar and is expected to generate cash flows of 30,000 US dollar per year for 5 years. Using a discount rates of 10%, you would calculate the NPV and IRR using the formulas and methods described above. This would require a financial calculator and or spreadsheet software. What's given in problem? The initial investment is 100,000 US dollar and annual cash flow is 30,000 US dollar. Project duration 5%, 5 years, and the discount rate is 10%. Using the PB or the present value of the cash flow in year T is in a present value year 1 is 30,000 US dollar divided by 1 plus 0.10 raised to year equals to 27,272.73 dollar. Next is the present value of year 2. 30,000, the same process, 30,000 divided by 1 plus 0.10 or 1.10 raised to 2 or raised to 2 years equals 24,793.39 US dollar. Next is the present value of year 3. Same process, 30,000 divided by 1.0.10 raised to 3 or 1.10 raised to 3 equals 22,539.45 US dollar. Next is present value of year 4. Same process, 30,000 divided by 1.10 raised to 4 equals 20,490.41 US dollar. The last present value of year 5, 30 divided by 30,000 US dollar divided by 1.10 raised to 5 equals 18,627.65 US dollar. Next is calculating and add the present value from year 1 to year 5. And then we need to subtract to initial investment. Our net present value is 27,272.73 plus 24,793.39 plus 22,539.45 plus 20,490.41 and lastly plus 18,627.65 US dollar. Our net, the total of net previous value equals 113,723.63 US dollar minus our initial investment is 100,000 US dollar equals our net previous value is 13,723.63. It means our IRR is approximately, the IRR is 15.24%. It means we accept the deal.